Imagine three friends who all start with exactly $10,000. They have the same amount of money, the same opportunities, and the same goal to build wealth. Fast forward 10 years, and their lives look completely different. One spends every day glued to stock charts, another patiently waits for the right opportunities, and the third barely checks the market at all. Surprisingly, the person who worked the hardest doesn't end up with the most money. So, what made the difference? Today, we're comparing day trading, swing trading, and index investing to see which strategy has historically been the most effective for long-term wealth. Meet Alex. Alex believes that making lots of small profits every day is the fastest path to success. Before the market opens, he's already sitting in front of 3 monitors with a cup of coffee, reading financial news and watching stock charts. As soon as trading begins, he's buying, selling, and reacting to every price movement. Some trades earn him quick profits, while others turn into losses. Every day brings excitement, pressure, and constant decision-making. Some evenings he feels confident after a winning session, but on others, he wonders where everything went wrong. His entire routine revolves around the stock market. Now meet Ben. Ben doesn't believe in chasing every market movement. Instead, he waits patiently for strong trends to develop. Sometimes he won't place a single trade for days. When he finally sees a high-quality opportunity, he enters the market, lets the trade develop, and exits when his target is reached. This is called swing trading. It requires patience, discipline, and far less screen time than Alex's strategy. Finally, there's Chris. Chris doesn't try to predict tomorrow's stock prices. Instead, every month, no matter what the market is doing, he invests the same amount into a low-cost index fund. If the market falls, he keeps investing. If it rises, he keeps investing. While Alex watches charts all day and Ben studies market trends, Chris spends his time with family, learning new skills, and letting his investments quietly grow in the background. Looking at these 3 approaches, you might expect the hardest worker to become the richest. But investing doesn't always reward the person who spends the most time in front of a screen. Sometimes, consistency beats constant action. So after 10 years, who actually builds the most wealth? Before we compare the results, there's one important lesson you need to understand. Earning money is only half the battle. Keeping it is what truly creates wealth. Before we reveal the winner, there's something every investor should understand. Making high returns means very little if you can't protect them. Imagine you invest $10,000 and earn 20% in 1 year. Your money grows to $12,000, which feels like a great result. But if you lose 20% the following year, you don't end up back at $10,000. Instead, your investment falls to $9,600. That's why successful investors focus just as much on managing risk as they do on making profits. This is where our 3 friends begin to separate. Alex continues making hundreds of trades every year. Every chart looks like a new opportunity, but every trade also brings hidden costs. Brokerage fees, taxes, and emotional decisions slowly reduce his returns. After a few losses, he feels pressured to win his money back, and after a few wins, he becomes overconfident. Instead of allowing his money to grow steadily, he keeps interrupting his own progress. Ben takes a calmer approach. Since he trades only a few times each month, he avoids much of the daily market noise. He waits for strong setups instead of forcing trades, which means fewer fees and less stress. But swing trading still requires good timing. Sometimes trends reverse unexpectedly, and even experienced traders have losing streaks. Chris, however, never changes his plan. Every month, regardless of market conditions, he invests the same amount into his index fund. He doesn't worry about today's headlines because he's focused on the next 10 years, not the next 10 days. Over time, this consistent habit allows compounding to work in his favor. Let's compare the numbers. For this example, suppose Alex averages 5% per year, Ben averages 9%, and Chris averages 10%. At first, those returns don't seem very different. But after 10 years, the results tell another story. Alex's $10,000 grows to around $16,300. Ben's investment reaches roughly $23,700. Chris finishes with nearly $25,900. The biggest surprise isn't just the money, it's the time each person spent earning it. Alex invested thousands of hours watching charts. Ben spent time researching trends. Chris spent only a few minutes each month following the same simple plan. Sometimes the simplest strategy turns out to be the most powerful. Before you decide that one strategy is perfect and the others are useless, it's important to remember that every approach has its strengths and challenges. Professional day traders do exist, and some of them achieve impressive results. But they spend years developing their skills, following strict rules, managing risk carefully, and controlling their emotions. What looks easy on social media often takes thousands of hours of practice behind the scenes. Swing trading also requires discipline. Waiting for the right opportunity is often harder than placing a trade, and many people fail simply because they become impatient or abandon their strategy after a few losses. Chris's approach may seem boring by comparison, but that's exactly why many long-term investors prefer it. Instead of trying to predict every market move, he trusts the growth of businesses over time and lets consistency do the heavy lifting. So let's compare our three friends one final time. Alex chose speed and excitement, but he also accepted the highest level of stress and risk. Ben found a balance between active trading and long-term investing, spending less time in the market while still searching for profitable opportunities. Chris chose patience, invested consistently, ignored short-term market noise, and allowed compounding to work over many years. None of these strategies guarantees success, and every investment carries risk. The best strategy is the one that matches your goals, your personality, and the amount of time you're willing to dedicate. If you enjoy studying charts and can manage your emotions, trading may be worth exploring. If you prefer identifying longer trends, swing trading might suit you better. But if your goal is to steadily build wealth while keeping life simple, long-term index investing is a strategy that has helped many investors over time. The biggest lesson isn't about choosing the fastest strategy, it's about choosing one you can follow consistently through both good markets and bad. In investing, patience often beats perfection, and consistency usually beats excitement. Remember, this video is for educational purposes only, and real market returns are never guaranteed. Always do your own research before making financial decisions. If you enjoyed this comparison and want more simple finance videos that break down complex topics into easy-to-understand stories, make sure to subscribe, and I'll see you in the next video.